Hope everyone's doing well. This is going to be a video over March the 23rd. Go back a little bit here. First thing to mention is the daily chart. And as you can see, excuse me, 6 consecutive bull days. The odds were we were going to pull back for a day or two and at least probably go sideways. So I thought, really for the past 2 trading days, I thought we were going to have a bear day. We almost did here. We didn't here. It's kind of a bull break out of a bull channel on a smaller time frame. So the odds were pretty good that we were going to pull back for at least have a bear close. Low one short below this bar, so again, I think we're going to go sideways and have a second leg up, probably test 4,600 and the top of this, which is basically the top of a wedge. And the bears, maybe they want a rally and then a micro double top with these highs, which would be a large double top, and then some sort of measured move down to here. 5-minute chart. So on the open, still have that triangle drawn. The first thing on the open you want to look for is extremes. So here's the low of yesterday, and let's say we just make that blue. So here's the low of yesterday, and on the open, I'll do it like this. There we go. So on the open, we had a bear doji close to the low of yesterday. Not a great short, probably buyers below, but we don't know how far below, and we could easily fall a couple points below here and turn up. So again, probably best not do anything, probably limit orders below. Consecutive bear bars, are we always in short? Probably not. Probably, we may get a second leg down, but I think we're getting an opening reversal. 80% of the time, you get a minor reversal. 50% of the time, you get a major reversal. Bull bar, but following 2 consecutive bear bars, closing below their midpoints, probably going to be at least a second leg down. I wouldn't buy above this bar. There's your second leg down, breaking below yesterday's low. Probably buyers down here. Some bulls will buy, use a wide stop, and look to scale one lower. Others will wait for the stop entry. It's a micro channel, so may get a second leg. And then big bull bar, micro double bottom, down, up, down, up. It's a reasonable buy. If you take the buy, stop below here. Other traders will maybe buy half a size position, put a stop below, and if they get stopped out, look to buy again on a full position. So trying to see if there's an example. And other traders, they may buy, use a really wide stop, and just buy more lower. Some traders, this bar is big, they may try and buy 50% pullback around 44.70. And there you go. So disappointing follow through, trading range open, and the channel was tight, so the first up is probably going to fail. Some bulls will buy, scalp out, and other bulls may look to, again, buy 50% pullback. I don't know how many would after a rally here, but again, I still think there's buyers below. So really deep pullback, sell the closed bears, disappointed here, look to get out break even. Now we have a micro double bottom, and the one thing to think about is this is a trading range open, and you have a micro double bottom. It's a wedge, 1, pullback 2, pullback 3. You can call it a truncated wedge. You can call it a second failed breakout below the prior day's low. It's a terrible stop entry. It looks like a terrible stop entry. However, it's probably reasonable. And some traders will just buy the close, stop below here, maybe here, betting that it triggers and betting that it's a trading range. Trading ranges have bad stop entries. Very big bull bar, and you can see on the open, price went 1 or 2 ticks below, turned up pretty strong. Strong enough breakout. You'll probably have a second leg up. And, the one thing, again, I'd be expecting today is I would go ahead and just, I'll do it here. I would go ahead and just mark the open of the day. And we'll do what Al does. Al typically makes it green. There's the open. I'm just going to go ahead and just keep that there because, again, I expect price to close below this. So big bull bar, but disappointing. Another big bull bar, probably buyers below and going up for at least second leg, breakout above this high. Maybe we go for a measured move up, but again, I think we're going to oscillate around the open at worst for the bears. So follow through, but disappointing. Gap down, so 50% pullback. Bears want a breakout pullback short test down here. And the bulls want a reversal. Testing the bottom of this trading range, so there's going to be buyers. Buyers bought anywhere in this price level. In theory, price gap down. They're going to get out break even over here. First reversal down is probably going to fail. So the one thing to keep in mind is risk reward. If you're buying here, your stop's below here. And, you know, hypothetically, this is what I think a lot of people have trouble thinking through. And it's kind of a hard concept, and that is you have two consecutive bull bars. In theory, what's the probability of buying? Stop below here, measure move up. In theory, it's at least 60%, so it's okay to do that. The problem is that the probability will quickly change every bar and, you know, technically every tick. So therefore, if you're buying this and you're using a wide stop, you have bad risk reward, which means you have to have strong probability in order to stay in the trade. Follow through, but pretty mediocre, so probably a pullback soon. Again, is the probability still 60 that you're going to get a measured move up? Probably, but again, you know, what about here? Okay, looking good for the bulls, but deep pullback, close this gap, so, you know, not as great here, more disappointment here. And at some point, you have to question, maybe the probability is 60%, maybe it's 55%, and you have to be very careful about using a really wide stop when the probability becomes more uncertain. It's like here, probability is 60%, you're going to go higher, maybe a measured move, but what happens here? This lowers the probability, and then you get two legs up in reverse. So what do traders do? They buy here, maybe they buy full size, they're disappointed, they scalp out most of their position, anticipating that they can buy more lower, or they scalp all out, anticipate they can buy more lower, and that they can get out up here. That's trading range price action. Bulls want to buy a pullback, and they want to get out back at the prior highs. So, you know, that happens all over. So here, testing down here, they're disappointed. They start buying back short. So what do I think? I think we're going to go sideways up here. I do think this is strong enough that while we have a wedge, 1, 2, and possibly third push up, this is probably strong enough to reset the count. So second entry short, big bear bar. So what happened here? Bulls began to give up on the thought of a measured move up, and they started scalping out of positions, and they want to buy lower. The bears sell aggressively, scalp out. So what's going to happen here? I think it's a pullback. Therefore, I think the bulls are going to buy. Maybe they'll buy this bar. Maybe they'll wait for the next bar to be weak, which it was. So it's a fairly deep pullback, closing these gaps. Again, trading range price action. So they shift. The bulls now kind of shift their focus. It's like it's similar to here, where the bulls, they're disappointed. And if you refer back to Al's videos on disappointment, entering late in a trend, I think, has some pretty good examples there in the how to trade section. Traders switch to wanting to sell out back at the high close. So high closes, disappointed, they look to sell out of their longs back up here. And there you go. So we tested up here, sold off. So now the bears see a low two, they see a double top, lower high major trend reversal. But again, it's a tight trading range, forcing you to sell in the midpoint. Not that great of a sell, but some traders will take it, stop up here. And if what I'm saying doesn't make a lot of sense, just keep watching the videos and thinking through it, and eventually it'll start to make more and more sense. And same thing here. This is testing the open of the day. We sold off X amount of points. Bears will look to sell X amount of points higher, betting the same thing. So I'm going to have to kind of skip forward a little bit, but okay. So again, disappointment, tight channel. It's a micro channel. You can call it a nested wedge, 1, 2, 3. Within a higher wedge, 1, 2, 3. But as I said earlier, this wedge is strong enough that this might be the first push, second, third. So we have a break above the wedge that failed, big bear bar, but again, it's forcing you to sell in the lower portion of the range. And that happens a lot in the trading range. It kind of like 2 days ago with this bar, big bear bar. It's a surprise, probably going to go a little bit lower, but again, traders sell, scalp out, and look to sell a pullback. So there we go. Big bear bar went down a little bit lower, tested back to the open. However, deep pullback. Notice the characteristics of this and what I just showed on Monday around 11 o'clock. Big sell-off, deep pullback, and so bear sell to close, disappointed, look to scalp out, and big bear bar. Now, is it sell to close? Probably, but again, it's selling at the bottom of the range, so you expect disappointment. Now we have a wedge, 1, 2, 3, and 1, 2, 3. It's an expanding triangle. So bulls want a reversal, bears, they want trend resumption, maybe a higher low major trend reversal, trend line break. So bear trend line break to a higher low major trend reversal, but weak stop entry. And what do you do if you're always in long? Well, if you're always in short, what do? You probably get out above this bar, maybe one tick above the bar. That's why it's dangerous to sell here, because we could easily get something like this and it would trap the bears. Now, kind of like that, and then boom. So bulls tried to reverse it, couldn't, big bear bar, and now we have a second entry buy. It's a credible stop entry, so bulls will buy one stop above, put a stop down here, betting on a micro double bottom, higher low major trend reversal, and it didn't trigger. Well, it did trigger, but bad follow through, and boom, now you have a bear bar. So now you have a bear breakout below a double bottom. 3 consecutive bear bars, probably going at least a little bit lower, and bull bar, but again, I'm going to have to speed up a little bit, running out of time. It's a bull bar, but it's following this. So you get a breakout below here. Basically, you're getting a breakout below a trading range for the past 2 hours, which means you'll have a lot of traders who will be suspect, knowing that most breakouts of trading ranges lead to trending trading range days, where you have a trading range, breakout, and then another trading range. So they'll be leery, and a lot of traders will want to sell pullback. And after they see this, they start to expect more trading range. So they sell up here, look to scalp out at new lows. Bulls start buying, look to scalp out at new highs. And we start going sideways for many bars. Hope this video helped.